In today's video, we're going to talk about diversification, and more specifically, diversification of the tax status of the different investments you have. Now, are most people doing this? Probably not. But I think it's important. If you want to get the most out of your retirement, you need to think about diversifying the tax status of your investments. That's what we're going to talk about next. Hey, this is Mel Stubbs. I'm a financial planner here at Christy Capital Management. And today we're talking about the tax status of your money. Now, most people watching this are federal employees or federal retirees, and so you've been saving your money in the TSP. If you happen not to be a federal employee, then you've probably been saving your money in a 401k, and so more specifically, the traditional side of your 401k or TSP. Now, some of you may have some money in Roth TSP, and some of you may have some just regular old money that you saved in your savings account or an investment account. But the vast majority of people that we talk to have most of their money in traditional retirement accounts. So first, let's go over what a traditional retirement account is and how it's taxed. This is income that you earned that you chose not to be paid on. So from your paycheck, you said, don't send it to me, put it in the TSP. And you weren't taxed on it. It's now in the TSP and it's growing. And one day when you take the money out, you'll be taxed at that point, just like it's your paycheck. If you don't ever take it out, then at age 72, there's required minimum distributions that'll kick in, and they'll force you to start taking some withdrawals out then, and you'll be taxed at whatever the going tax rate is for your income in that year. So it's good to get to postpone some taxes, but what could be bad is that one day you have to pay taxes and you don't know what the rates are going to be then. So this is one of the different buckets that you have that you can put your money in. And now the next bucket of money is one that you have to pay ordinary income taxes on. This is your income. This is earnings from CDs, savings accounts, money market accounts, bonds, and certain annuities. You're taxed at your tax bracket or ordinary income tax rate. And for a lot of people, this is how you earn your money. And then you decide what to do with it, which bucket to put it in after you earn it. So this bucket is called the ordinary income tax rate bucket. The next bucket of money is if you just have regular old money, it's not retirement money, but it's invested and you're making a profit, then you have to pay capital gains tax rates on those gains. Now, if you have a non-qualified investment account that earns a profit and you've held the investment for longer than 1 year, you pay capital gains rates. If you hold the investment for less than 1 year, you'll pay ordinary income tax rates. So for this bucket, we're talking about the long-term capital gains, which for right now in 2022 are 0%, 15%, or 20%. In 2022, if you're married filing jointly and your income is $83,350 or less, you'll pay 0% capital gains rate. If your taxable income, married filing jointly, is between $83,350 up to $517,200, you'll pay 15% on capital gains. And if your income is above $517,200 a year, then you will pay 20% capital gains rates. All of these taxes are cheaper than the ordinary income tax bracket that you would normally pay at those same income levels. So the key thing here is you're only paying taxes on the profit or the gain. So if you have a $100,000 balance and you've held it for over a year and now it's worth $110,000 and you sell everything, you're only paying taxes on the $10,000 profit, not the entire $110,000 distribution that you took. Now the fourth tax bucket is Roth or tax-free. Now there's basically two ways you can get money from this type of bucket. Either a Roth IRA, Roth 401k, Roth TSP, or by taking withdrawals from a cash value life insurance product. Now for this video, we'll stick to just talking about Roth, but do know that if you set up a properly funded life insurance policy and follow all the IRS rules, you can take money out tax-free. So as for Roth, you can contribute inside of your TSP to Roth, and you can also contribute to a Roth IRA on the outside of your job as long as you meet certain income restrictions. To be able to contribute to Roth IRA, if you're single, your income needs to be below $129,000. If your income is somewhere between $129,000 and $144,000, you can contribute some to Roth. And if you're above $144,000, then you are phased out and cannot contribute directly to a Roth IRA. If you're married filing jointly, these numbers are $204,000 to $214,000 in 2022. So if you're married filing jointly and your income is below $204,000, then you can contribute to a Roth IRA for yourself and for your spouse. So that would be $6,000 each if you're under the age of 50 and $7,000 each if you're both over the age of 50. The way Roth IRA works is that you get to put the money in after taxes, meaning after you've already paid taxes, the money goes into your checking account, then you contribute to a Roth account. That money gets to grow, and if you access the money after the age of 59 and a half, And then after you've reached 5 years of having a Roth account, you get to take the withdrawals tax-free. And when you take the distribution, everything about it is tax-free. It does not show up on your tax return. It does not factor into the equation to determine whether Social Security is taxed for you. It would not be a factor in the equation of what your Medicare premium would be. Medicare premiums are based on your income. So a distribution from Roth IRA does not count as income. So if we just do a quick review, we have a bucket of ordinary income tax money. We have a bucket of capital gains money. We have a bucket of traditional money, meaning you got to take a distribution, you got to pay the ordinary income tax then. And then we have a bucket of Roth money that's tax-free, where there is no taxation. Now, for the most part, most people are traditional heavy, meaning the vast majority of their assets are in a traditional account. When can that backfire on you? It backfires anytime you need to take a distribution. It's going to be taxable. What happens if you want to buy a house and you need to take a large distribution? Let's say $150,000 down payment. The entire thing will be taxable. Just to give you an idea of the math, let's say you need $150,000 for a down payment. You're in the 24% tax bracket because you're having to take such a large distribution. It's probably going to push you up to the 24% bracket. And then let's say that the state income tax is 5%. That means you're going to have to take a distribution of $211,267 just so after you pay all the taxes, you get your $150,000. For a lot of people viewing this, it seems somewhat penalizing. Now, if you had the money in a non-qualified account and you only had to pay capital gains on it and you need to take out $150,000, you would need to look back to see what did you buy it for and what did you sell it for. You only have to pay taxes on the gains, and you'll have to pay it at the lesser capital gains tax rates. Taking a large distribution from this type of account, it doesn't mean you have no taxes, but it's probably going to be better taxes. And even better yet, let's look at the Roth account. If you need $150,000 for a down payment, you can reach into a Roth account and take a $150,000 distribution, and it's not taxable. Of course, we're assuming that you're over the age of 59 and a half, that you've had the Roth account for at least 5 years. If those things are true, then the $150,000 distribution is not taxable. When you're in retirement, you want to have options when things come up and you need to get that money. In a perfect world, you have money in all the different buckets, and so that way you can have a choice of what to do. Typically, when a client calls up and they need a large distribution, we'll set up a time to meet and go over it. What does it look like if you take this distribution from each one of your accounts? Let's talk about what the taxes look like from taking it from each one of the accounts. It usually becomes obvious that taking the money from one account over the other accounts makes a lot more sense. You only get to go through this process if you have multiple buckets. If everything you have is in one bucket, then you don't have a choice. And if taxes go up and you need a large distribution, it may not be a pretty sight for you if all the money is traditional. So how do you go about getting money in the different buckets? How do you diversify your investments? You have to make a conscious decision to allocate it that way. You need to build up some regular money, like an emergency fund, that's not retirement money. Most people have already built up their traditional bucket. Lots of people have not done any type of Roth to build up any type of tax-free money. Well, you can change that. So how do you build up money in the Roth account? Well, we already went over how you could contribute either $6,000 a year or $7,000 a year, depending on your age, into a Roth IRA. And inside the TSP, you can contribute directly to Roth TSP. Now, whatever you're contributing can go to Roth, but do remember the match from the federal government will go to traditional, but you can still contribute to Roth. If you're maxing it out, that means you can max out everything to Roth. And for a lot of people we're talking to, they have large traditional balances. Being able to contribute another $25,000 a year to Roth is nice, but it doesn't fix the problem of having, let's say, $800,000 in your traditional bucket. To diversify your tax status of the money, you will need to do Roth conversions. This is where you take a portion of the traditional money, for instance, let's just say $50,000, and you move it to your Roth account, and in doing so, you'll be paying taxes at today's rate. Now, once the money shows up in the Roth account, it can now grow tax-free for the future. Each year, you take a chunk of money and you move it. Each year. It's not something that can be fixed overnight because you'd have to pay too much taxes if you tried to fix it overnight. Anything you move from traditional to Roth is taxable this year. So for instance, can you take $600,000 from a traditional balance and move it to Roth all at one time? Technically, yes, but would it be smart to do that based on your tax bracket? Probably not, because that means your income would be $600,000 higher than it normally would have been, which means you would have moved up past the top bracket and into the 37% tax bracket. Most people would not want to do that. But if you're ordinarily in the 22% bracket and you could move $50,000 to your Roth account and stay in the 22% bracket, a lot of people would think that's a good move. Others are willing to even go up to the 24% bracket. Lots of times you can move maybe $150,000 or so to Roth and stay in the 24% bracket. Now the next bracket up is 32%, and for most people that difference between a 24% bracket and a 32% bracket is too great and they don't want to do that. So this is something that needs to be planned for year by year. You may want to work with a professional who can look at your tax return and help you figure out how much room do you have left in your bracket so that you can Roth convert enough to do the heavy lifting, but not so much to cause excess taxation. Please note that the TSP does not let you do this type of planning. You will have to move your money out of the TSP into an IRA in order to do this. So over time, you can get to where you have money in each of these buckets. And that way, whenever life throws you a curveball and you need to take some money out, or maybe there's a wonderful opportunity and you need to take some money out, you can have choices of where you take it out from. Now, after watching this video, if you think this sounds like a good idea, but you really don't know how to implement it, reach out to us at christycapital.com. Call the number on your screen. We'd love walking clients through this process of figuring out where your money is currently, where it should ideally be. What can we do about your investments? Not only diversifying with how aggressive or conservative it should be, but also diversifying it based on the tax status of it. If you're looking to work with a professional to help implement this in your situation, please reach out to us. This is what we do for clients. Clients that are a good fit working with us usually fit into 3 twos. Either they don't know how to, they don't want to, or they don't have time to. If you realize that this type of planning is important, but you don't know how to do it, you don't really want to do it, you don't have time to do it, please give us a call that we can work with you and help you through the different stages of getting this worked out for your situation. My name is Mel Stubbs. Please go to our website, christycapital.com, give us a call on the number on your screen, leave a message so that I can get back to you. Our goal is to help you have the best retirement that you can have, and diversifying based on tax status is important. My name is Mel Stubbs. I'll talk to you on the next video. We need to do the proper disclaimers. The purpose of this video is not to give specific tax advice or investment advice. We're going over general principles and ideas that can be used, and if used correctly, can save and avoid taxes. You're going to want to work with someone personally who knows your situation personally. So seek out advice from an independent financial advisor. This is for educational purposes only. I hope you enjoyed the video.